Welcome to Smart Spreads. Our goal is simple: to help traders better understand the markets, structures, and seasonal forces that drive commodity spread performance. In this video, we'll examine an important concept that can help improve trade selection, risk management, and overall market understanding. Most traders spend their time analyzing price charts. Spread traders should spend more time analyzing forward curves. While outright traders focus on the price of a single futures contract, spread traders trade the relationship between contracts. The forward curve heavily influences those relationships and often reveals more about a spread's potential than the price chart itself. So what is a forward curve? A forward curve is simply a snapshot of futures prices across multiple contract months. Imagine lining up every futures contract in a market from the nearest expiration to contracts several years into the future and plotting those prices on a chart. The resulting line is the forward curve. For example, a crude oil forward curve might include contracts for July, August, September, October, and November. The shape of that curve shows how the market values future delivery relative to the nearby delivery. Most forward curves fall into one of two categories: positive carry or negative carry. In a positive carry market, deferred contracts trade at higher prices than nearby contracts, creating an upward sloping curve. This structure often reflects storage, financing, and insurance costs associated with carrying inventory over time. Many agriculture and financial futures markets spend much of their time in this type of environment. For spread traders, positive carry often creates a natural tendency towards spread compression as the premium is deferred contracts gradually erodes. The second kind is negative carry markets, which display the opposite structure. Nearby contracts trade at higher prices than deferred contracts, creating a downward sloping curve. This typically occurs when immediate supply is tight relative to demand, causing buyers to pay a premium for prompt delivery. Energy markets frequently exhibit this structure during periods of supply stress. In these environments, spread expansion can persist much longer than traders expect. So why does this matter? Many traders focus almost exclusively on seasonality. Seasonal patterns can be powerful, but they represent only part of the picture. Two trades may have identical seasonal patterns, yet perform very differently depending on the structure of the forward curve. A trade occurring in a positive carry environment may benefit from a natural tailwind. The same trade in a negative carry environment may require much more precise timing and more favorable market conditions. What the curve says about risk. The forward curve also provides valuable clues about risk. Steep curves often indicate stronger underlying forces at work, while flatter curves may suggest a more balanced market environment. Understanding that structure can help explain why some spreads move smoothly while others experience sharp volatility. One common mistake is treating the forward curve as a trading signal. It isn't. Think of it as a roadmap. The curve shows the terrain. Seasonality, technical analysis, and trade selection determine which route you choose. The most successful spread traders combine all of these factors rather than relying on any single one. Most traders focus on price. Spread traders focus on relationships. A few tools reveal those relationships more clearly than the forward curve. In our next lesson, we'll examine how carry and trade direction interact to create dramatically different performance profiles across commodity spread markets. Thanks for watching. If you enjoyed this video, visit bullstrangle.com for additional research, education, and the Smart Spreads newsletter. For a deeper dive into commodity spread trading, be sure to check out my book, Trading Commodity Spreads, which is available on Amazon. We'll see you in the next video.